Looking as well at Santos, that is an important stock move lower. It has crumbled over 9%. Its second quarter revenues falling. Maybe we animate into a chart on this one just to sort of bring it up to some kind of a notion on. Oh, that's an interesting view. You kind of got a snap view of it, and Christine Ip is standing by one of those screens as well to talk on this inevitably for you too. Let's cross to her at Bell Direct now. Christine, welcome. I know not part of sort of the slated chatter, but when you can't ignore a stock like that falls out of bed by 9%, and I suppose in a sense, should we be surprised that the revenue's fallen away given the state of the energy industry at this point in the cycle with the backdrop of those weakening commodity prices?
Not a huge surprise, and it's just to do with that overall negative sentiment on oil and energy stocks, and I think we'll see a little bit more of that next week when Santos, when some of the other energy players report for earnings season. Now, but this week it is the banks that continue to drive that market volatility. It's been a pretty crappy week. We're down more than 2% for the week, and again it highlights the main themes we've been seeing for this earnings season, which is improved margins from that lower Aussie dollar. There's been impairment charges left, right and centre thanks to the commodity correction, but it is the banks that is driving sentiment on the market. CBA, like you mentioned, still in a trading hold, but it is looking to open slightly lower than its last closing price of $82.12 a share. And investors are still reeling from ANZ's poor earnings update, so its shares are down 1.4%. Bendigo Bank still on a downward slide thanks to the loss of earnings momentum it's reported, so it's still down 1.5%. The lift in provisions that we've seen from ANZ and NAB have also really worried investors, although for very different reasons. NAB shares are down 0.3% today. We've also seen CBA's bad debt charge tick up. So throughout the trading updates, we've seen banks flag that lower Aussie dollar. There's been worries over provisions, but there's still a lot of uncertainty in outlook. So banks are weighing on the overall market this week. Hopefully, once we see capital raising out of the way, there is going to be more emphasis on resuming earnings growth and return on equity. But for today, we are seeing a flat session for financials. Overall, it is looking like we're finishing down more than 2% for the week. And next week's attention is going to shift from the banks with some big names like Qantas, Wesfarmers, Origin Energy, Fortescue, Woodside. So it's been all about the banks, but next week, mining and energy companies will be the headline.
Okay, eyeing a nice rally and one that's not exactly been paired either in AHG, of course, Automotive Holdings. This after its 12 months ending June 2015 full-year earnings came out, and you're looking at the bottom line NPAT, good gains, 21% on the PCP. Encouraging result.
Very encouraging, good gains. So the truck and car retailer reporting the 21% jump in full-year profit to $88 million. So that's up from $72.9 million the previous year. Like you said, revenue up 11%, and we did see the company continue to deliver value to its shareholders by lifting its final dividend to 13 cents a share. Now, the auto retailer has been very upbeat about their outlook for the industry. Bell Potter has a buy rating on the stock, and they recently raised their price target to $4.70 a share. Now, that's because we've seen low interest rates continue to increase consumer demand for new vehicles and also allow better floor financing rates. Now, Automotive Holdings operates as Australia's largest automotive retailer. Its latest result is displaying the benefits from its large economies of scale and efficient inventory management. They hold 11 out of the 12 most popular passenger vehicle brands. That's giving them a strong competitive advantage. And their refrigeration logistics division has also been operating in a much improved environment. The recent consolidation has been a boon for the company. They've acquired Scott's Refrigeration Freightways and JAT Refrigeration Road Services, and that division has actually delivered a 41.7% lift in revenue. Now, its strategy will continue to divest non-core assets as well. It's going to mean more cash free for new acquisitions, which has been hugely successful for the company. The lift in profit is largely due to the Bradfield Motor Group acquisition. That's made an outstanding contribution to the automotive retail division, which recorded a 10% jump in revenue. So a very upbeat result for Automotive Holdings, and its shares are up over 4% today.
Okay, also intriguing this comment by Sonic. So it's lost out in Alberta, Canada, believing it had these lab services contracts the pipeline of them as well locked in, but has said that alongside it, having to say now that the government, has changed its mind there, but stressing, look, these figures were not part of its FY16 forecast, right? I mean, it doesn't seem as if investors are wholly taking note of that.
That's absolutely right. Not part of its forecast, and I think that's one of the good things about Sonic. It's very transparent in terms of its guidance. So disappointing news with Canada foregoing a $200 million a year contract for Sonic to provide pathology services in Edmonton. Now, Sonic was set to be the preferred provider of laboratory services for the Alberta government, but changes in opinion, like you mentioned, on the proportion of health services provided by private companies has put a hold on the deal. It is disappointing news. Sonic was banking on the North American expansion to boost its credentials and its earnings, and the contract was expected to deliver over $200 million a year over that 15-year period. Sonic is set to report on its full-year result next Tuesday. Last month we did see Sonic trimming its guidance for its 2015 earnings to $730 million, down from $762 million, which is still a bumper result. And both Sonic and its peer Primary Healthcare have introduced certainty into reporting season by downgrading their guidance. Sonic's guidance didn't include the potential earnings, like you mentioned, from the proposed contract with Alberta Health Services, but it is that certainty in its earnings and the US dollar exposure, and that has meant Sonic Healthcare and other healthcare stocks have been top picks this earnings season. So unfortunately, a bit of bad news for the company, and its shares are down about 1% today.
Okay, listen, have a great weekend and appreciate you joining us today, Christine. We'll talk to you soon.
Thanks, Carson.
Christine Epstein.